All right, guys, let's take a look at IAS 8 example, but on changes in accounting policies. We said that changes in accounting policies include changes in measurement basis, like changing inventory valuation from FIFO to AFCO or AFCO to FIFO. And this question deals with this. You see, we have AFCO here and we have FIFO here. So this is a change in accounting actually policy. Let's just read the question. We are told that most of Tanshil's competitors value the inventory using AVICO basis, whereas Tanshil uses the first in, first out basis. The value of Tanshil's inventory at 30 September 2010 is how much? You know, this is the year end. The year ends 30 September 2010. On the FIFO basis is 20 million. However, on the AVICO basis, it would be valued at 18 million, right? But also we are told that if by adapting the same method as competitors, if this Tanshil copied its competitors, the assistant accountant says the company would improve its profit for the year ended 30 September 2010 by 2 million. Now you want to see if this is right or not. That's just the opinion. Tanshil's inventory 30 September 2009, you know, 30 September 2009, actually at the end of the previous period, that means at the beginning of this year. This year end 30 September 2010, that means it started 1st October 2009. 1st October 2009 is actually the same with this, almost the same with 30 September 2009. So simply speaking, this would be the opening inventory. This would be the inventory on the opening date, and this would be the inventory on the closing date. And we are told here that Tanshil's inventory at 30 September were worth 15 million. However, on the AVICO, in case it was using AVICO, it would have been reported at 3.4 million. So we just go to the same comment. Comment here. Comment on the acceptability of the assistant accountant suggestions and quantify how they would affect the financial statements if they are implemented under IFRS and we have to ignore taxation. So let's take a look at this. How should we go on about this? The simple manner here, the simple way is just to take a look here. Let me prepare something and show you matters that are important. Now, if you go and look here now, look here. First of all, you have to understand, we are speaking of inventory. Now, you know, let me tell you one thing. I think you know how to compute cost of sales. Let us start from here so that you understand me well. Inventory is somehow tricky because cost of sales equals to opening inventory plus, let's say, purchases or production. If you are producing, less closing inventory, isn't it? Now, the closing inventory is at the end of the year, and actually our year ends at 30 September 2010, right? What about the opening inventory? The opening inventory, the year starts at 1st October 2009. Are we together? This is what the real situation is. Now you have to ask yourself, currently, as of now, the company is using FIFO. All right? The company is using FIFO, and we are told that the value of Tanshil's inventory at 30 September under FIFO is 20 million. This is 30 September 2010. That means this is the closing inventory. So the closing inventory right now is 20 million. Just like that. I think everything is all right here. But we are told that on AVICO basis, we are told here it's 18 million. So in case we were using AVICO basis, right? This actually inventory would have been valued at $18 million. All right? Yeah, this is the case. Now to go further, you ask yourself, we are told that Tanshil's inventory at 30 September 2009, which is the opening inventory actually, it was 15. It was 15 million, just like this, 15 million. But here also we are told that under AVICO, if it used AVICO, it would have been 13.4 million. Now, first of all, before doing anything, you have to ask yourself, is this a change in accounting policy or a change in accounting estimate? As I told you, if you change the measurement basis of, say, inventory, of anything. If you change the measurement base, except, let me give an exception. For example, when studying IAS 16 PPE, revaluation of assets, when you revalue the asset, even if it was, we were using cost model and then went to revaluation model, we do not say that actually is the change in accounting policy. We account for it prospectively. That is an exception. The standard said that. But here we have just changed this inventory. That means we have to apply it retrospectively. So even if this, we expected to just change at the end of this year, that is September 2010, we also have to adjust everything in the previous year as much as we can. That's why we are also considering this. Now just take a look here. It's something very simple. You won't believe it. You won't believe this. Just take at the effect. Just write the effect here. Effect. Let's just take a look at the effect. Now listen. This is under FIFO. This was 15 million, but under AVCO, it would have been 13.4. So actually cost of sales would have gone down, right? This would have led to the decrease in cost of sales, right? Decrease in COS, I mean cost of sales. What would have been the decrease in cost of sales? It would have been 15 million minus 13.4, right? 15 million minus 13.4, ending up with 1.6 million, just like this, right? Yeah, just like this. But also let's proceed here and see what we have to do. Now, in case this was a closing inventory and you moved from FIFO to AVCO, closing inventory would have fallen by how much? Closing inventory would have decreased by 2 million. Now you see, closing inventory is subtracted from cost of sales. So if closing inventory falls by 2 million, that means cost of sales would have increased. There would have been a increase in cost of sales by how much? By, this is 20 minus 18, remaining with 2. This is what would have happened. 2 million. Now just get a look. Cost of sales would have decreased by 1.6 million, but also it would have increased by 2 million. So what would have been the net? The net would have been increased by 2 million, but decreased by 1.6. There would have been a net increase, right? So we say that net increase in cost of sales would have been 2 million minus 1.6 million, that remain with 0.4 million. This would have been the net increase in cost of sales. The net increase in cost of sales actually would mean a decrease in profit, right? Because we're just checking the impact on profit. So it would have led to the decrease in profit. Cost of sales, the amount by which cost of sales increases will actually lead to decrease in profit. So our profit will decrease by the difference, that is 0.4 million. So this is how you deal with such matters. Now let's just take a look to read everything, all explanations, and we'll be done with this question. We could just finish up with the last one. Now let's go. Let's go and take a look. Case 2. This is the solution. Now, as I said, both methods being acceptable in value inventory, both methods are being acceptable in value inventory as per S2, changing an accounting policy to be consistent with that of competitors is not a convincing reason. This is the first point, because it said competitors were using AVCO, Tanshiro was using FIFO. You wanted to change just because of copying competitors. It doesn't make sense. You do not change accounting policies as you see fit. You only change them when you have to comply to a standard, or when actually it would give you more relevant and reliable information. So first of all, it was the wrong reason to change the accounting policy. Again, generally, changes in accounting policy should be avoided unless a change is required. I think I already spoke about this. I already spoke about this just now. You should not change accounting policy unless a change is required by a new standard or by the standard, or the policy provides a more reliable and relevant information. I've just spoken about this. This is an explanation that you have to pay attention to. Don't just focus on calculations. So what? The assistant accountant calculations are wrong. They actually are wrong because as I've shown, that's what should have happened. So they are wrong and would not meet the intention of improving profit. A change in accounting policy must be accounted for retrospectively. As I told you, if it's a change in accounting policy, you have to go back. That's why we went back to the opening inventory. That were the closing inventories of the previous period, right? So if we check here, we said closing inventory of 2 million. There was a decrease in closing inventory of 2 million because FIFO was 20 million, but AFCO was 18 million. So this would decrease the closing inventory and hence decrease the profit by 2 million. While the increase in opening inventory of 1.6, which is 15 minus 13.4, would increase profit, and the net result being to decrease profit by 0.4. Don't worry, I just started with cost of sales because those figures are on the cost of sales. So I think that I gave you just a better explanation because we started with cost of sales and then we reverted to profit. So that was a much better explanation. Now, another point to note, if you are not available in the morning sessions, is that when there is a change in accounting policy, you have to restate the balance of retained earnings at the beginning of the period under question. So retained earnings brought forward should have changed, right? By how much would they have changed? It's just simple, yeah. Let's just read this part. It's simple because we have already spoken about it. We say that this will be reduced by 1.6 million due to fall in closing inventory at the end of 2009, and this adjustment would be shown in the statement of changes in the statement of changes in equity. You know why? These are retained earnings at 1st October at the beginning of the period. So we adjust for everything in the past. We do not deal with closing inventory. Closing inventory will actually affect the profit in the current period. So that inventory, you know, initially inventory was how much? Inventory was how much? We said that there will be an increase in actually inventory was 13.4 under what? Under FIFO, but under AFCO it increased. Let's go back to check the question so that we finish explanations here. Where the question is here. Yeah, for the year ended at 30 September 2009 here, inventory was 15 million, but AVCO said that it would have been 13.4. So under AVCO it was 13.4. That means our inventory would have to be reduced by the difference of 15 minus 13.4, which is 1.6. So closing inventory should have decreased by what? By that much amount. That's why we'll go and adjust. Sorry. That's why we'll go and adjust what? That's why we'll have to go and adjust the opening balance of retained earnings. So here we are told this will be reduced by 1.6, these retained earnings, due to the fall with this. We said that this will be reduced due to the fall in closing inventory at the end of 30 September 2009, and this adjustment would be shown in the statement of changes in equity. Retained earnings is part of equity. So when there is a change, you have to go there and incorporate that change. Go to the statement of changes in equity, prepare the line of retained earnings, make your changes there, just like that. So this question is over. If you can still proceed, I think we can finish up with this last question and all will be fine.